Welcome to day 74 of the Storage 100 series. I'm Joe Downs, and today we're getting into the world of mortgage brokers and how the right one can open doors you didn't even know existed. Quick reminder, the Storage Moguls community at storagemoguls.ai, that's storagemoguls.ai, is a free AI native learning platform with tools built to help you learn and execute across every storage vertical. With multimodal learning, GPT powered tools, immersive content, you can start for free, advance at your own pace. All right, let's get into it because today we're tackling a critical question for every investor. When should you hire a mortgage broker and when should you go direct to the bank? So, financing is the lifeblood of our business, and knowing how to secure the best debt is a non negotiable skill for scaling your portfolio. So, we need to understand the value proposition of a mortgage broker, which is essentially paying someone to find you the best capital. And this decision isn't about saving a few bucks, it's about maximizing your deal's potential and minimizing your risk. So let's start by defining exactly what a mortgage broker brings to the table. Think of them as the ultimate intermediary, the bridge between you and the massive capital markets out there. They take your loan package and they shop it to maybe even dozens of banks simultaneously, which is something you simply don't have time or the relationship to do for yourself. This process of shopping your deal is key because it creates a competitive environment, for one. The broker then leverages that competition to negotiate better rates and terms than you could likely get on your own. And they're paid to know the market better than you do, and that knowledge is their primary value. So, all right, let's dive into the specific advantages this process gives you. The biggest is obviously the access to the market. So the brokers have relationships with national banks, credit unions, and specialized CMBS shops that you've never heard of. And this access creates a bidding war for your loan, which is how they drive down your rates and improve your terms. Beyond the money, though, they save you immense time handling all the paperwork and packaging, which lets you focus on operating your asset. They're also the experts in deal structuring, knowing how to tell your story to overcome, the inevitable underwriting hurdles. But the service isn't free, so we need to look at the other side of the coin. While the pros are compelling, you need to be clear-eyed here about the cons and, more importantly, the costs. So the primary cost being the fee, which is typically 1% of the loan amount. So think about that. On a $2 million loan, that's $20,000 coming out of your pocket. So you need to make sure the broker's value exceeds the cost. Another potential downside is the middleman effect. Communication could be slower since you aren't talking directly to the decision maker until late in the process. And not all brokers are good. A bad one can shop your deal so aggressively that lenders start to view it as damaged goods. So you have to weigh the cost against the value they bring to your specific deal, which leads us right to the question at hand. When is that cost worth paying? So considering the 1% fee, you should only hire a broker when the deal is complex enough to justify the cost. Using a broker for a heavy value add project, properties with low occupancy, or unique asset types that require strong narrative to sell to a lender, good idea. If you're a first time buyer, a broker is invaluable because they lend their reputation and credibility to your loan application. They're also essential when you have a tight timeline and can't risk a lender dropping the ball. And if you need specialized financing like non-recourse or CMBS debt, brokers have the specific contracts that you need. So if your deal fits any of those criteria, then you should absolutely hire a pro. So then what does the opposite scenario look like? Well, when it makes more sense to bypass the broker and just go straight to the bank. So you should do that when the deal is simple, local, and you already have a strong relationship with the bank even. Maybe you bank there. Local banks love lending on local assets in their own backyard. They understand the market and they want to keep the business close. Also, for loans under $1 million, brokers sometimes won't take those deals because the fee that they'll make is too small, or they'll have to charge you, more than 1% to make it worth for them, and that's coming out of your pocket. So the biggest benefit of going direct then is saving that 1% broker fee, which can be pretty significant. So if you can handle the process, keep the money in your pocket. But if you do need a broker, then you need to know how to find a good one. And since we know when to go direct, let's focus on how to find a quality broker when you need one. So you don't just Google a name. You ask for referrals from other storage owners, or maybe your attorney or your CPA. This network is your best resource for finding proven partners. Definitely check their track record. Make sure they've closed on self-storage deals recently. Generalists aren't going to cut it because storage underwriting is specialized. So you're going to want to interview at least 3 brokers, compare their fees, their strategy, and how well they understand your specific deal. And then finally, verify the relationship by asking which lenders they have direct access to for this type of asset. A right partner is worth the search, folks, so don't settle for the first one you find. But as you search, you need to know the red flags to watch out for, too. Because while finding a good broker is essential, avoiding a bad one might even be more important. So the first major red flag is large upfront fees. Legitimate brokers get paid at closing, not before they deliver results. Never pay thousands just to start the process. Another huge warning sign is a broker who guarantees approval. No one can guarantee a loan approval. And if they promise 100% success, you should probably look the other way. Also, avoid generalist brokers who lack any specific storage experience. They won't understand key metrics like economic occupancy or ancillary income, which are vital for underwriting. And then lastly, watch out for pushy sales tactics. If they pressure you to sign an exclusive agreement immediately, they're desperate and you should trust your gut. If it feels wrong, probably is. All right, so that's the ins and outs of working with banks and brokers, and it all comes down to this simple thought. A good broker pays for themselves by finding better deals and better terms than you could find on your own. They open doors to lenders that maybe you didn't even know existed. Conversely, a bad broker costs you time, money, and worst of all, credibility with lenders and maybe even your deal. They can sour relationships that take years to build. So the choice is yours, but choose wisely. All right, next up, day 75, where we will dive into creative financing, master leases, and JVs. If you found this information helpful, please like this video. It helps us reach more people in the storage community. Subscribe to the channel so you don't miss any of the 100 days of content. And please share this video with someone considering using a broker when they don't need to. They will thank you later, or conversely, if you think they should. And remember, a great mortgage broker doesn't just find you a loan, they find you the right loan, the right one. And that distinction can be worth hundreds of thousands of dollars over the life of that deal. So if you want to connect with other investors who've navigated this process before, the Storage Moguls community is free to join at storagemoguls.ai, storagemoguls.ai. Why? Because we're AI powered. See you tomorrow on day 75.